Let's get to that conversation with the management of Suryoday Small Finance Bank. Then we have Mr. Baskar, Babu, Ramachandran, MD and CEO joining in. Mr. Ramachandran, thanks very much for being with us. You know, your guidance has been extremely strong. I think it's 30 to 35% growth from what I remember. That's credit growth that you're talking about. But even if I look at ROE, you're guiding for 18 to 20% growth in ROE by FY25. You're also meeting a lot of investors. Just trying to figure out, are you at all looking to raise any fresh equity capital? Or are you looking to get any new institutions on board at all?
Thank you. Good morning. So we aren't really looking to raise any capital, considering that our capital adequacy is pretty high at 35% at this point of time. Even observing for the growth of 30%, which we guided for this year in terms of assets, we still be in a very comfortable capital adequacy. And our PPOP, as guided, was around closer to 37 crores last month of the Q4, and continuing that, we are really looking at something like around 500 crores of PPOP for the year, considering that we do not have any immediate plans to raise capital. However, where there is any opportunistic possibility of raising capital, which is good in terms of making robust, we will.
Okay, so you're not looking to raise any fresh capital, at least in the immediate term, you're saying. So do give us a breakup of the guidance. I mean, 30 to 35% credit growth over the next 2-3 years. But where will this come from? Which segments, which geographies? Describe the lay of the land to us a bit.
I think across the industry, the microfinance industry is expected to grow anywhere between 15 to 20% consistently over the next 3 years. On the back of it, we are looking at around closer to 25% growth. We do not have deep penetration in some of the states we have been operating for long. During the COVID period, we didn't really expand. So considering we will don't enter exactly, deepen some of the geographies where we are present, which include Uttar Pradesh, Rajasthan, Karnataka, Madhya Pradesh. The growth will come on back of that. Also, we are looking at graduating our JLG customers into individual loan customers. Played out pretty well last year. We currently have 1,200 crores portfolio. The intent of that is to make sure that the customer becomes a holistic banking customer with multi-relationships, not just lending. For 1,200 crore portfolio, 2 lakh customers at this point of time. We'll add another 2 lakh customers from our existing base. And we're also looking at acquiring new-to-bank customers in the Baskar loan product, which is a flagship product, and bundle it with a few other very critical products like PMJJY, PMSBY, to make it comprehensive offering for the customer individually first and thereafter the household. Fairly confident that we're headed for a 25 to 30% growth over the next 3 years.
This Vikas product, how is it done in the first 2 months of this quarter?
Consistent as it was. We do around close to 50% of our overall inclusive finance disbursement Vikas loan. We do not want to accelerate much more than that. It will be a slow process, but currently we are acquiring around closer to 25,000 customers in that. So on that basis, we are likely to end up with closer to 4 lakh customers at the end of this financial year.
What is the AUM at the end of May in this product?
No, as of March, it was 1,200. Likely that it will be closer to around 2,000 crores at the end of this year.
Okay. Mr. Babu, I wanted also your thoughts on how your business mix is expected to change over the next few years. So, just for the benefit of our viewers, over 60% of your business comes from MFI loans, followed by, of course, CV loans, small portion of it from there, then a small portion from housing loans as well, about 10% or so. Would you be looking to sort of reduce your exposure in the MFI segment, increase in other segments which are rising, like perhaps CVs, affordable housing, etc.? And what will the loan mix look like 1 to 2 years down the line?
The growth in the non-MFI business, which includes affordable home loan, secured business loan, commercial vehicle predominantly, will be a little higher than the microfinance portfolio. So with readjustment, we are not slowing down growth in the inclusive finance segment, but however the growth within that would come in from Vikas loans. And we are covering majority of the Vikas loan under credit guarantee scheme called CGFMU, which makes it, if not fully secure, quasi-secure for taking care of the one-off events which happens in the industry once in 4 or 5 years. There is an event which creates a credit loss of closer to 7 to 10% on the industry level. So we want to protect that. We are investing in that, I would call it, rather than a cost. This year we will cover closer to around 80% of our inclusive finance portfolio under the credit guarantee scheme. So the ratio will be 55-45. We are fairly comfortable. In a couple of years' time, it is likely to be 50-50. And we will continue to be a solid financial inclusion player. So which means that inclusive finance will contribute around 50%. Majority of it will continue to be business loan and secured in nature, but covered by the credit guarantee.
So in these pockets like affordable housing and commercial vehicles, since you're planning to scale that up as a portion of your overall business, can you help us with what the growth rates could be over there, both in affordable as well as commercial vehicle?
Both of this at the AUM level, given that they are long annuity products, would be closer to around 40% in both of this, both in affordable loan, secure business loan and commercial vehicles.
Okay. Mr. Ramachandran, want to speak about margins a bit as well, because I think in the fourth quarter you were at a pretty robust level of 10% plus. I think it was 10.4, if I have the right numbers. So now what happens from here on? Because there's a general expectation that this is the peak of margins and we'll see margins cool off. So give us your view on that. And obviously, when we talk margins, we also have to discuss your cost of funds and then therefore your deposit franchise. How much are you looking to grow deposits to fund the kind of growth that you outlined earlier?
Deposit growth, considering that the base is not very large, would be around closer to 35 to 40%. The focus on that always for us has been in terms of granular deposit. 80% of the deposits are less than 50 lakhs in terms of relationship value. Likely that it will be in the same range or inch up a little more. So we are focused on that, and the growth hence would be around closer to 40% for this financial year. And
so what would the credit deposit ratio be, sir? Just to understand, what is your credit deposit ratio now and where do you hope to take it to?
It's around closer to 115%. It will go to around less than 110 during this financial year, and the intent is to take it to 100% by FY25. However, the gap between these is funded not by any short-term loans or other borrowings. They're all funded only by refinance from NABARD, SIDBI, Mudra at this point of time.
Okay, we'll leave it at that. Mr. Basu, thanks a lot for joining in. Mr. Babu, sorry, thanks for joining in, and I appreciate your thoughts to talk about the FY24 outlook.